Ever stared at a stock chart and felt like you're looking at the actual matrix? All those chaotic lines, acronyms, and squiggles just blurring together? Well, you are exactly in the right place. Welcome to this explainer. Today we're going to take that totally confusing alphabet soup of market charts and transform it into an accessible, highly practical tool belt. Think of this not as a dry finance lecture, but as an exciting driver's ed course for your trading journey.
Okay, let's just dive right in. Looking at all these acronyms, EMA, VWAP, RSI, MACD, ATR, it honestly feels like trying to read a foreign language, doesn't it? It's incredibly common for folks to get stuck right here, totally intimidated by the sheer volume of the jargon. But don't worry, we are going to decode every single one of these today. By the time we're done, you're going to be reading these charts like a seasoned pro. Here's our roadmap for building our dashboard today. First up, market foundations. Second, tracking the trend. Third, measuring momentum. Fourth, understanding volatility. And finally, putting the tools together to see how it all works in the wild. All right, Section 1, Market Foundations and Volume. Look, before we bolt on any of the fancy dials to our dashboard, we have to establish the basic ground rules of the road. Without these foundations, the advanced stuff won't mean a thing.
It's really helpful to think of price movement like physical architecture. Think of support as a literal price floor, where buyers historically step in because, hey, they think the asset's a bargain. Resistance, on the other hand, is your price ceiling, where sellers take over because the price is getting just a little too high. Whenever a stock is moving, it's basically just bouncing between these invisible floors and ceilings.
Our next core concept is volume, which you can think of as the actual roar of the engine. When you see a high volume breakout, meaning a ton of shares are swapping hands, the engine is roaring. That move is strong and reliable. But if a stock breaks out on low volume, well, the engine's sputtering. It might run out of gas and reverse on you pretty fast. Always look for volume to confirm what the price is doing. Moving right along to Section 2, Tracking the Market Trend. Now that we've got our foundation of support, resistance, and volume, it's time to install the GPS to figure out which direction the market is actually traveling. Our first advanced tool is the EMA, or Exponential Moving Average. Markets are incredibly noisy, jumping up and down minute by minute. The EMA simply smooths out all that chaotic action to reveal the true short-term path. Because it gives more weight to the most recent prices, it reacts way faster to trend changes than a simple average ever could. The golden rule here is beautifully simple. If the current price is trading above the EMA line, the trend is bullish. The buyers are completely in charge. If the price falls below the EMA line, it's bearish, and the sellers have taken the wheel. You always want to trade in the direction of the trend, and the EMA gives you that direction at a single glance. And let's add another tool to the mix, the VWAP. Now, I know volume-weighted average price sounds deeply complicated, but it's actually super intuitive. It just tells us the average price paid for an asset, calculated by how many shares were actually traded at those prices, not just the price itself. Institutional traders heavily rely on this one. What's genuinely powerful about the VWAP is how it draws a literal line in the sand. It tells us definitively if the bulls or the bears are winning the intraday battle. Price above the VWAP, buyers are firmly in control. Drops below, sellers have the upper hand. It acts as a massive dynamic support and resistance level all on its own. All right, Section 3, Measuring Momentum and Shifts. We know which direction we're heading, so let's check the tachometer on our dashboard to see exactly how hard the market is pushing the gas pedal. Are we accelerating or are we stalling out? Enter the RSI, or Relative Strength Index. While the EMA and VWAP tell us the trend, the RSI measures the momentum of that trend. It runs on a scale of 0 to 100, letting us know if a current price trend is totally exhausted and ready to pull back, or if it's just getting started with plenty of runway left. If you see the RSI push above 70, that is your signal to pause. The market is overbought, meaning buyers might be exhausted and a dip is probably imminent. Conversely, an RSI below 30 means it's oversold. The sellers push too hard, and the stock might be due for a bounce. It's a fantastic gauge for spotting market exhaustion. Let's pivot to the MACD, Moving Average Convergence Divergence. This is another momentum gauge, but it's specifically designed to help us spot exactly when a trend is starting to change direction. It compares two different moving averages to visually show us when the market's energy is shifting gears. Watching for crossovers on the MACD is an absolute game changer. It's exactly like seeing a traffic light turn green for buyers or red for sellers. When the faster line crosses up over the slower line, boom, you get a bullish crossover and buying momentum is building. When it crosses down, selling momentum is taking over.
Section 4. Understanding price volatility. Okay, we have our GPS and our tachometer. Now we need a seismometer on our dashboard to warn us about the bumps in the road ahead. We have to know how wildly the price is actually swinging.
That seismograph is the ATR, or Average True Range. Unlike the other tools we've looked at, the ATR does not care if the price is going up or down. It strictly measures volatility, period. It simply answers the question, on average, how many dollars or cents is this stock actually moving during a given time frame? A high ATR, buckle up. You're entering a period of massive price swings. Think less Sunday drive, more roller coaster without a seatbelt. That means larger potential profits, but way higher risk. A low ATR means you're in for a relatively smooth, quiet ride with tighter price consolidation. Knowing your ATR is absolutely crucial for setting your expectations and your safety nets. And finally, Section 5, putting the tools together. We've decoded the alphabet soup, we've built our complete trader's dashboard. Now let's see how all these instruments work together in harmony to spot an actual high-quality opportunity.
The golden rule of using this dashboard is you never ever rely on just one single indicator. A smart trader builds a case. You check the trend with your EMA and VWAP, you measure the momentum with your RSI or MACD, you respect those historic support floors, and you always wait for high volume to confirm the move. When they all line up, that's your high probability setup.
Looking at this pristine, bullish setup, we see it all coming together. The price pulls back directly into the EMA cloud right near the VWAP line, which is acting as dynamic support. Right at that level, we get a bullish engulfing candle, where that big green candle completely swallows the small red one, accompanied by high volume. Literally every dial on the dashboard is screaming that buyers are back in control.
But as we wrap up this explainer, we have to pause and ask the most important question of the day. Does having all this dashboard data perfectly aligned guarantee that you'll win every single trade?
The answer is absolutely not. And that's exactly why we must remember this vital warning about risk management. The market can stay irrational longer than you can stay solvent. Indicators give you probabilities, not a crystal ball. So as you take this new tool belt out into the real world, the final question I leave you with is this. Are you prepared to diligently protect your capital for those inevitable moments when the market simply stops making sense? Thanks for joining me on this explainer today. Keep learning, keep observing, and keep growing.